Good morning, everyone. And our resource person, Assistant Governor, Mr. Karunaratne, and also the participants, and also the Director of the College of Banking and Finance and the staff. Let me first apologize everyone for the technical problem I had from this side. And I'm extremely happy to welcome all of our participants to the IBSL virtual school actually. Now this is a virtual school now. Because of the current situation, now we were able to establish this online classroom. One way it was good because now earlier there were some problem with the students who were far away places and they could not attend to the classes because of the traveling problems. Now we have resolved that problem. Then today we are going to start this integrated risk management program. I am not a risk expert, but this morning I Googled a little bit about what the integrated risk management is. Risk, they say it is a situation in exposing someone or institution to a danger. That is the risk. And integrated means combining all aspects. Management, we know management is how to manage the situation. That is the integrated risk management program. And it also says the managing the integrated risk is creating a culture where the management feels if some situation is emerging in whatever the aspects, the management start feeling it. So that is the culture related to integrated risk management. Today, our resource person is going to inculcate that culture in you. Let me formally invite Mr. JPR Karunaratne. He is the assistant governor, one of the assistant governors in the central bank, and also he had a very long career in the central bank for more than 20 years now, I guess, more than 20 years. And also he has been associated with the IBSL for a long period as a lecturer, for a long period in many aspects. Now you are seeing his credentials, and he's, let me read the entire list, if Mr. Karunaratne permits me. I have received it, and in addition to being the assistant governor, he has been a fellow of the Chartered Institute of Management Accountants, CIMA, and also associate member of the Institute of Certified Management Accountants of Sri Lanka. And very rare opportunity, he has been able to be the advisor to the Defense Ministry in financial matters. And there he got very deep exposure to a very critical and sensitive area. So it's a very rare opportunity. He is resourceful with that experience as well. And also he has been, in addition to that, he was the team leader of the research project Basel III implementation. We know the banking sector is a very dynamic sector. From time to time, depending on the developments and also the emerging problems, they introduce different guidelines. Basel III is the latest one. Most of the banks in Sri Lanka also planning to join. I think they are joining. And Mr. Karunaratne was also engaged in that process. Then when we look at all those things, there's a long list, but I'm not going to say it. I know Mr. Karunaratne will permit me not to do it because now this itself, what I said itself, this witnesses to his career as a risk manager. Not on theory only, there's a practical aspects in vast areas, central bank and defense, and there are so many other areas. And also internationally, banking sector is managed according to principles of this Basel III, Basel principles. The latest one is Basel III. Then you can see his local as well as international exposure to this field. He is one of the most suitable resource persons to inculcate that culture that you all as managers in the banking sector need to be a successful career banker. With that, let me hand over the forum to Mr. Karunaratne. Thank you very much, sir. I am really sorry again for the delay from my side. Thank you.
Can we start now? Yeah. Okay. Very good morning to all of you. Can you all hear me?
Good morning.
Yes,
Yeah,
good morning.
Yeah. Good morning to all of you, even though I can't see you. So first of all, let me express my gratitude to the Director General, Mr. Karuna Tilaka, for giving a very kind introduction of myself and background behind me and my experience with respect to different areas. So, of course, today's topic is on risk management, which is very well discussed from today's context. As you know, we are undergoing number of risks consequent to COVID-19 crisis. So I think it's a widely discussed topic, even though we have been discussing risk management in financial institutions for so many years. Certain unexpected events happening, we have not, maybe most of you have not experienced, but now we have a greater experience after the COVID-19 problem. Okay, so so this is the first time I am also putting my effort through this online mechanism, even though we have participated in many online discussions related to our official matters, but not really related to conducting any lectures. So I think this is a good opportunity for us also to experience the technology and developments taking place in the technology to address situations like this. So again, let me thank Director Ms. Kodkand and the team for inviting me for this session. And as a part of resource person of this entire program, and there is another permanent resource person in this program, Lalit Fernando, who was a retired Central Bank of Ceylon DGM, and subsequently worked in other financial institutions as well. So I think he also has a vast experience, mostly practical experience related to the topic and the subject which we are going to start today and continue through about, I think, around 15 lecture series. Entire program is about 15 lectures, I hope. So basically, so you will gain understanding about many aspects of risk during this program. Again, one more thing I want to emphasize you, I think this program was developed in 2012 as an initial program, where the idea was to enhance the knowledge, practical knowledge of officers working in financial institutions of the risk faced by them and how they can ensure those risks are mitigated prudently. So with that objective, I think this course was initiated in 2012, but it has developed over years. I think almost 8, how many years, or maybe 8 years. This has been continued until to date, and hopefully I think this is a good opportunity for anybody working in a financial bank or financial institution to do this course. So I think probably the Director General also would agree with me to look at courses like, basic courses in the IABF, DABF is focusing mainly on theoretical aspects. But here what we expect is to enhance your knowledge in practical aspects as well as theory, but where you can really practice what you learn here in your day-to-day working environment. So that's the most important aspect. Because if you look at the bankers today, there's, most of you are qualified, well qualified, even central bankers. But what we see is when it comes to practical aspect, how you can apply theory into the practices you adopt in day-to-day businesses, you find there are so many issues. So that's why it's very important for you to apply the knowledge you gather in these courses to improve your processes or adopt good practices in your day-to-day business environment, whether you work in a bank, financial institutions, or any other organization. So I think course covers broadly the overall process behind risk management. Today we start with a basic introduction. What is risk? I think already Director General mentioned a few things about the risks and risk management. So we will start with a brief introduction today and probably continue towards next week. Then there are other aspects to risk, many aspects. If you look at from a banker's perspective or a person in a financial institution, there are many risks faced by you all. Credit risk, market risk, operational risk, liquidity risk, strategic risk, so many risks. So if you look at as a banker, as a person working in a financial institution, there are many more risks you face in your day-to-day conduct of businesses. So then there are programs covering all those aspects, theory as well as practical, and then we will move on to some theories behind regulatory frameworks which are directly applying to the risk factor. So I think Director General mentioned about Basel framework, which is widely used and widely expected all around the world by the central bankers, and also that is applied to the bankers, specifically bankers, and also gradually move into application of Basel to non-banks as well. So we will touch on what is Basel and what things Basel application relate to risk part. There are so many Basel applications with respect to the banking, but here we touch on how Basel capital accords link to the risk management and risk aspects. And of course, when you talk about risk, again, important area is governance. So we will touch upon the governance aspects as well towards the latter part of the course. And so basically at the end of the course, I think you will be you should be able to apply any aspect of theory or practice into a day-to-day businesses in your bank or financial institution with respect to risk, with respect to regulations, mainly Basel aspects, and also how you can build up governance cultures within your respective institution. So broadly, that is the course structure which I was asked to brief in short by the director, Ms. Godaganda. And so I will not elaborate in detail, but you will come to know about those things in detail once the respective resource personnel start delivering lectures on those areas. So anytime if you have any concerns, you can disturb and interrupt and join the discussion. Even though this is what we have to do during the COVID period, but it may not be very active, but still for all, you are free to stop and clarify things, because one of the other problems, the risk faced by lecturers is that we don't get any good feedback from the audience. That is very important, because I mean, you have to clarify whatever things you need to clarify. Don't wait till end of the day or last minute before the exam. So please clarify. We will try our best to answer your questions. Even if we can't answer a particular question at this moment, we will try to find the answer the next day or whatever date we will see you again. So that is again an important factor, because what I see is, again, I want to inform you that now you should not do these courses just to add some qualification. I think most of you come because this may be an important item for your next step in your career, maybe promotion or maybe whatever you want to do in your career. So, but okay, that's fine, but don't just confine that getting this qualification to that, but try to use it in your day-to-day businesses to improve your processes. That is very important, because as bankers We can't continue working in the environment we worked in 50 years ago, 40 years ago, 10 years ago. World is changing, you see. So even now technology, I mean, if the technology has not developed to this extent, how can we have a dialogue with you all? So that's the, benefit of technology. So technology risk itself is a risk, So you ask bankers, if you don't improve or enhance your, processes to cover up the technological risk, again you are in trouble. So when you talk about risk, technological risk is also one of the important elements. So, so I would rather prefer, before we start, I would like to have a little introduction from you all. So, yeah, I can see the names of the students who have registered yet. So let's start with, hopefully I hope that I will pronounce correctly, but if I make a mistake, please correct it, because I really don't know whether sometimes certain names looks like lady or gentleman, but let me start with what I see. So you can say a little bit about you, where you work, and what is your background, how many years of experience you have, so that it may be very much useful to see, for me to see what is the background where you all. So let me start with Asanka Veerapperuma. Can Asanka explain a little bit? Can Asanka hear me? Or if not, we can move to the Bimsara Gajadira. Bimsara, can you hear me? Hello. Can you talk to the mic? I can't hear you. Mr. Bimsara, hopefully Bimsara. Can you hear me, or can you, I can't hear you. Oh, shall we go to then Chaitani here again?
Hello, Mr. Konraratna.
Yes.
Can you hear me?
Good morning.
Good morning.
Yeah.
I'm Uttara Chaitani. I'm working at National Savings Bank.
Yeah. So how what is the area you engage in at present, and how long you have been with the savings bank, or your total banking career experience? I mean, in maybe few words.
I'm currently engaging the compliance division, and
Okay.
I've been there for 4 years now.
Okay. So how long? So that's in the NSB, but how long you have been in? I mean, have you worked in any other places? So what is your experience?
Yeah, before joining the bank, I was at KPMG Corporate Finance.
Okay. Okay. Thank you, Chaitani. No.
Thank you.
Okay. Thank you.
Chaitani.
Chaitani. Okay. Thank you. Dimuthu Muthukuda.
Hello.
Dimuthu,
Yeah. Hello. Can you hear me?
Yeah. I can hear you. You can.
Good morning, everyone. I'm Dimuthu. I'm working for Commercial Bank, and I have 13 years experience in the bank. And of course, 4 years I worked as a credit officer. And presently, I'm joined with a specific project done by the bank. So my education background, of course, I'm graduated from University of Zabaragamuwa, followed by an MBA of University of Colombo. So that is
okay. Dimuthu, thank you very much. Okay.
Thank you.
Then can we hear something from Harsha Premachandra? I don't know, Harsha or Harsha? No? Then we'll move on to Nishant Ihelage. Nishant Ihelage, is it? Yeah. No? Okay, then we'll move to Ishara Ishani. Okay. Nishanta? I can't hear you. No. Nishanta, can you explain a little bit about yourself before we move on to the session? I think you are on the mic. No? We can't hear you. I think something wrong with your mic. Okay, then we'll move to Ishara. Ishani.
Hi, I'm
Hi,
working
Ishara.
at Pan Asia Bank.
Yes.
And I do have almost 7 years banking experience and 3 years from operation risk.
Okay. Operational risk.
Yeah.
Okay, so that's good. So you can see what we are discussing and how those things apply, or whether if you are not learn anything, probably you will have a good understanding. So okay, thank you, Shara. Then we'll move to Jenny. Jenny, can we hear you? No. Okay,
Hello.
Jenny. Yeah, Jenny.
Hello.
Yeah.
I worked at HNB for 2 years at the internal audit department.
Yes.
Then I'm working at PwC as an audit trainee for now.
Okay. So you shifted from your banking career to a more audit-based career.
Actually, I was on contract basis. That's why.
Okay, so probably this may be useful in your audit career when you do audit in banks.
Yeah.
Okay. So, okay. Thank you, Jenny. Then Kavinda.
Hello.
Yeah.
Currently, I'm working at CFA Finance PLC and I'm attached to the credit risk department.
What is the company? Which PLC?
CFA Finance PLC.
CFA. Okay.
And I'm currently attached to the credit risk department and I'm working there for about 4 years.
Okay. Thank you, Kavinda. Then Kumara Mendis. Kumara, can you hear me? If not, we will, for the benefit of time, we will go to Kumudumali Hera. Kumudumali Hera. Kumudumali, can you hear me?
Yes, good morning, you all. So I'm working in University of Wayamba in Department of Banking and Finance as an academic member.
Okay.
So I'm very much interested in the field of risk management, and since this is I perceive as a best course, so I joined with it to have a good knowledge and have a very good to start a very good rapport with you, sir. You all.
Okay.
Yeah.
So your expectation is a little bit different as a lecturer in the university. You said Wayamba, no?
Yes, the Wayamba University.
Wayamba University. Yeah.
I think you have came to our university several times, and the director Bindu Karnatilaka sir also he have visited our university.
Okay. Anyway, it's good, Kumudu, that you want to apply or maybe in your teaching. To deliver whatever the developments taking place in the banking sector.
Pioneer institution in banking and finance, your institution I observed, so I joined to have a good knowledge on the field of risk management.
Okay. That's fine, Kumudu. Okay, thank you, Kumudu. Then we'll move to Lahiru Navaratna. Lahiru, can you hear me?
Yes, I can. Good morning. I work at LB Finance.
Yeah.
As a junior analyst, risk management. So I have almost 2 years of experience.
Okay. So basically, you just joined LB. Have you worked anywhere else before? No.
Before I worked at SJMS Associates as an internal auditor.
Okay. Good. Okay. Then we'll move to Lakshika Navodya. Lakshika.
Good morning, sir.
Good morning.
I'm working in People's Leasing and Finance.
Yes.
I recently joined with PLC. Before 4 months ago.
Yeah.
I need for risk and control department.
Yeah.
For that, I need extra. I am from financial background.
Yeah.
Therefore, I want knowledge about risk and control.
Okay, Lakshika. So this is your first job, or have you worked any?
I have get training of Ernst & Young EY.
Okay.
EY internal audit department.
Okay. Thank you. So hopefully this would be beneficial for your career as a beginner.
Yeah.
So let's see how it goes. Then thank you very much. We'll move on to Madhusanka Vaduganayaka. Yeah, Madhusanka, can you tell a little bit about yourself? Is Madhusanka with us? No. Then shall we move to Nilmini Priyanti? Nilmini, can you switch on your mic? No. We'll move to Nilushani Vijayaratna. Nilushani Vijayaratna. No. Nimesha Deshani. Nimesha, are you with us? Oh, no. Nirendra Fernando.
Yeah, good morning.
Good morning, Nirendra. Yes.
Yeah, I am in Head National Bank.
Yes.
So I was in branches and doing credits.
Yeah.
So please now from next Monday I am going to take up work at this department. So
okay.
one of this is there. He has done this one. So join this.
Yes.
So I just want to join and know what about it.
Okay, good. So you will see how best you could apply whatever the knowledge you gather here during the course to your new area of risk.
Yes.
And of course, if you have any problems, you can contact us anytime. Okay, thank you, Nirendra. Then we will. Okay, thank you. We'll go to Niroshan Karunatilaka. Niroshan. Prasad Priyankar then. Prasad. Rajiv. Okay, Roshan Ranasinghe. No. Selva Chandran Arunakumar. No. Then Shashika Shashika or Shashika, I don't know. Veera Singh. Yes.
Hi, sir. Good morning.
Good morning, Shashika.
I'm working in Tanisha Bank for almost 9 years. I'm currently working at Credit Risk Department, sir.
Okay. Good. Okay, then we'll move to Suren Abesekar.
Yeah, good morning, sir.
Good morning.
I'm working HNB Finance as a head of recoveries.
Yes.
So HNB Finance is a subsidiary of HNB Bank.
Yes.
So I have been in the collections field over 22 years in the collection and recoveries field. So before I joined HNB Finance, I worked for CDB, Citizens Development Business Finance, as an assistant manager of recoveries.
Okay. Thank you, Suren. Then we'll move to Tamara Ratnayaka. Tamara, can you explain a little bit about yourself?
Yes, sir. Good morning.
Good morning.
I'm Tamara Ratnayaka, working for Alliance Finance Company PLC.
Yes.
Last 14 years, I was heading the financial reporting and compliance section.
Okay.
And last 6 months, I was overlooking the risk management section. Now I have been transferred to risk management.
Okay, that's good. So you have so many years of experience, and probably this may be very much useful. And hopefully you will use the knowledge you gather here in your day-to-day working environment in future. Okay, Tamara, thank you very much.
Thank you, sir.
Yeah. Oh, last one, Vasanta or Vasanta, I don't know. Sakala Surya. Vasanta or Vasanta, I don't know. Can you hear from Vasanta or Vasanta? No? Okay, so I think some of you explain in very short what you are doing right now, what you have been doing in past, and what is your background, and also the experience in the field. So most of you already working in a bank or financial institution, but there are a couple of you from the students I talked just now. One in, I think, audit firm, another one in the university, where you still need the knowledge in risk management, because the work you are doing is directly related to the risk management. Okay. So I think already Mr. Karunathilaka gave a introduction about my professional career as well as the experience, but let me give a little bit in very short the academic background. I started my academic career as a graduate from University of Colombo in mathematics and statistics with first class honors, and then of course I did my postgraduate diploma in applied statistics again from University of Colombo, and I did my master's degree in commerce in the University of New South Wales, Australia, specialized in finance. Okay, so even though I started my academic career as a mathematician or statistician, now basically I am in the area of finance and financial management. So I have been also working with the IBSL for so many years, as Mr. Karunathilaka mentioned, and of course throughout this course since 2012 as a resource person, in addition to other resource person. So today what I will do is give a basic introduction about risk management and probably continue to the next day, and then probably as I explained to you about the whole structure, the other schedule will start by the next resource person and continue. Then again I will join you when it comes to certain other modules towards the course. So one important thing is I expect all of you to participate in the lectures regularly, unless there is specific reason to be absent, because if you skip one lecture, probably you may find it difficult to catch up it during the next lecture, and also these are interrelated. So I encourage all of you to participate in the lectures every day. I think it's now pretty much easier through online sessions where you can join from your home. So that is the first suggestion I want to make. Ensure full participation. You don't miss anything. And also the second advice is that interact with us to clarify your problems, because sometimes we will go pretty fast depending on the time we have. But if you miss anything or if you don't understand anything, please stop us, myself or any other resource person, and clarify those things. Don't wait till last minute. Even if you don't want to clarify, you can we can spend little time after the presentation. Still you can join with us and of course clarify those things. So that is again the second thing I want to mention. And third thing is when it comes to the bankers, you can't just restrict your knowledge to whatever the things we learn here in the class. But there are a lot of things happening in and around the world, in Sri Lanka and many aspects, many parts of the world, with respect to risk management, financial institution management. So it is very important for you all to know about what is happening in and around the world. Because one issue I see is, one concern is when we ask about what happened in US today with respect to interest rate, most of bankers, they don't know. So that's pretty sad thing. So basically, as risk managers, especially as risk managers, you want to know what is happening in and around the world with respect to economic and financial matters, even other matters, certain disasters, especially COVID, how it impacted many business organizations throughout the world. So that's very important. So look at to do that, you must read newspapers, you must listen to the many other aspects where you can gain knowledge, maybe through the internet or whatever other mode. So that's very important. So to see what is happening in and around the world and how those events could impact your bank, your institution, that is important. So why we need to look at now, let's say, for example, US interest rates are going to go down. So what is the risk to you? So there are so many risks to you as a banker, you as a person working in a financial institution. So that is the importance of that event. So if you know things happening, then probably you can take measures in advance before you face with significant risk. So that is the other important thing. The other thing is apply this knowledge in your day-to-day business environment to improve the processes. As regulators, we come across during examinations of your banks or financial institution many weaknesses, problems with respect to risk management, with respect to credit, with respect to many aspects, governance or whatever topic you talk of. So that's very important. So whatever the knowledge you apply wherever possible, you may not be able to apply each and everything depending on the environment and systems you have in your bank, but discuss with your superiors. This is what I learned. So can we do these changes to our systems, our processes, to improve the processes or reduce the risk? So probably then your superiors will look at those things positively. That's good for you, that's good for the institution as well. So think about it and apply whatever the things you learn here, not just for your, as I mentioned earlier, for your career promotion or anything, but to career improvement in your workplace and also for the benefit of your institution. So those are the few things I want to mention before we move on to the session today. Okay, so let me again welcome all of you for this session, and also those who didn't join us, probably you can join us later. So as I mentioned, you can stop me at any time if you need any clarification. I will try my best to clarify whatever the things you raise at this moment itself, but if anything I can't clarify, so I will try to clarify it later. So with that, let's move on to the session. So what is risk? Does it really matter? I think some of you are already in the area of risk. So what is risk? Does it really matter? Can I hear anything from you all? What is risk? I think today when we talk about risk, one of the greatest risks we have ever seen in during our lives is the COVID-19 risk. Okay. So does it really matter? Of course. Okay. So what is risk? Does it really matter? Yes. So let me take an example of risk. How do we perceive risk? And what happens if that risk event takes place? So why does it matter? So let me take an example. So this is something told by E.J. Smith in 1907 from a paper presented by E.J. Smith. So who is E.J. Smith? He is one of the famous captains of ships for many more years and with a lot of experience. So when somebody asks about risk event that could take place while ship is moving in the sea, so what's the answer he gives? So you can see, when anyone asks me how I can describe my experience of nearly 40 years at sea, you see the experience he has, So basically, if somebody has 40 years experience at sea, definitely he would have come across many more events, risk events, and also he has mitigated, controlled, or been subject to such risks. So he knows what has happened and what are possible things that could happen. So I merely say uneventful. Of course, there have been winter gales and storms and fog and the like, but in my all my experience, I have never been an accident in any sort worth speaking about. So basically what he says, so during his 40 years career, he doesn't see, he has not experienced, or he doesn't see any sort of severe accident. Never been in an accident. He has never been in an accident. So it's good. Despite, there were winter gales, storms, fog. So what does he wants to tell about a risk event he could experience is very remote, isn't it? So basically he expressed it's very remote. I can experience a serious risk event. So let's continue. What I have seen, but one vessel in distress in my years at sea, all years at sea. I never saw a wreck and have never been wrecked. So he hasn't seen any ship being wrecked due to an accident or risk event. No, I was ever in any predicament that threatened to end in disaster of any sort. So basically what he say, as per his experience, he doesn't expect any risk event end up with a serious threat to life of him or any person in the sea inside the ship. So basically, in sum, what he want to say is he has experienced many bad events, winter gales, storms, fog, everything. But the consequence, as per experience, has not been that serious, and he doesn't expect even such a serious event in future. So that's what E.J. Smith told in 1907 to a paper. So let's move. What happened in 14 April 1912? I think with the famous song which we very much fond of listening, Titanic song, we know what happened to Titanic ship. So the ship sank with loss of 1,500 lives, one of which was its captain, E.J. Smith. So see, Mr. Smith told the chances of a very bad or very worse event happening is very remote. But 5 years later, what happened? He mentioned 5 years ago, he has never seen a ship being wreck of a ship. But now what happened? After 5 years, the ship in which he was the captain sank with loss of 1,500. So it's a great, significant risk event in the industry of ships and also in the world at that time. See, so what does it tell you? What does it tell you? So we never predict a risk event take place, despite we haven't experienced a significant such risk event in the past. I think to this I can add the COVID-19. Okay, so before December last year, no one experienced. Okay, if something is going to happen in the poor third world countries, okay, everybody experience things are happening, things can happen. But here in COVID, what happened? It's not the countries like Sri Lanka or third world countries experience the significant consequences. It's the whole developed nations like US, Europe, the Far East countries. Okay, so you see the risk. Okay, so you can't simply ignore a risk event will take place because such an event has not taken place. So that's why it's very important for us as bankers, for us as people working in financial institutions, to ensure we are safe, we have proper systems, we have proper capital, we have proper risk management policies and procedures in place to manage those risks. We can't stop a risk event take place. But what we can do is we have proper system, policies, procedures in place to mitigate such risks. So that is the whole purpose of risk management, the topic which we are going to discuss today. Okay. So, but does any of this really matter now? Yes, now we experience the recent risk event. When I did this course last session for the students of last batch, I have not talked about prospective another risk event. But now, today, I can talk about COVID-19. I think most of your banks have been affected. Most of the financial institutions have been affected. It has not in a direct way, but indirectly. The risk faced by other institutions in economy has now caused a risk event in your respective organization. Okay. So when we talk about risk management casualties, we can talk about many. Among them, I have highlighted few, which I'm not going to discuss in detail. Some of them, these you have already heard. The Barings Bank collapsed. Bank of Credit and Commercial International, BCCI, which we had a branch in Sri Lanka as well, about 30 years ago, and which was also closed down. Hoover, the Sumitomo Bank, Enron, WorldCom, one of the leading telecommunication giants in US, Parmalat. So it's not only the banking industry institution, but industries or institutions in many other areas also. Well-known giants in developed countries have failed because of poor risk management culture. Okay. So at the end, we have learned the lesson why these institutions have collapsed. It's purely due to the poor risk management culture. So if you have opportunity to look at these things, okay, you will come to an understanding of exact causes of these failures. Okay, then you will see on all these cases, there's an element of risk management, or rather poor risk management. So let's move to risk. So what is risk? We talk about risk. I think Director General explained, a little bit. So risk refers to the uncertainty that surrounds future events and outcomes. Okay? It refers to the uncertainty that surrounds future events and outcomes. It is the expression of the likelihood and impact of an event with the potential to influence the achievement and organization objective. So basically, when you start business, why a bank doing business, So banker is financed partly by shareholders and the depositors. So basically, when shareholders set up a banking institution, a financial institution, so he has basic objectives in mind to make and return. Okay. So where he deploy a team of officers to run the business under a board of directors. So they basically then you have a potential set of goals to achieve. So in order to achieve goals, you set certain targets, okay, strategies, KPIs. Okay. So the question is, even though you want to achieve certain things, whether you can achieve, you expect a profit of 10 billion next year, but you may not be able to achieve 10 billion next year due to certain bad events, unexpected events, expected events. Okay, so basically risk is the uncertainty surrounds future events and outcomes. So it is if you relate to the mathematics of risk, the possibility that actual outcome deviates from the expected outcome. So you expect a return of 10 billion, but you may end up with 8 billion. So you are short of 2 billion from your expectation due to whatever events that take place in the business. Okay. So here we talk about risk in banks and financial institutions. So risk is common for any business, or for us, isn't it? Even for us. Now today in the morning, we started, of course you may be at your home, but I started with the objective of coming to IBSL and deliver this lecture. So that was my objective and that's my expectation. So I left home at 8 o'clock with the expectation of being here at 8:30. So that was the expectation. So in my journey, am I exposed to risk? Can we hear from some of you? I would like to hear from some of you. So when I start, or when you start, let's say you are coming for the lecture, even though today you are at home, you leave home at 8 o'clock. So with the objective of being at the lecture hall at 8:30. So when you leave, and while you are in your journey to be here, are you exposed to any risk? Can we hear from anyone? Yeah. Okay. Yeah. So what are the risks you are exposed to as in?
Yeah, you can see in the vehicle. So vehicle can be break down in between.
Yes.
Or suppose you can get caught to a traffic jam or something like that.
Yeah.
So any uncertain thing can happen.
Yeah. So what's your good name?
I'm Filan, doing as Nirendra.
Okay, Tilan, no?
Yeah, Filan.
Okay, Tilan. I think it's rightly said, Tilan rightly said, okay. So I mean, when you start, maybe you are coming in your vehicle, you expect vehicle is in good condition. Okay?
Yes.
But unfortunately, without your knowledge, there may be a problem inside the engine. So probably vehicle may break down on the way. So what happens if the vehicle break down? Definitely you may not be able to come on to the lecture on time. Okay, so basically you expected to come on time at 8:30, so you can't come, so you miss the lecture. So it's a risk event. Or then you may meet an accident you never expected. Okay, and even with your general knowledge, you know there could be a possible accident, but the accident you met is totally different to what you have been experiencing. Okay, so that is called the unexpected event. Okay, or maybe bad weather. The road may be flooded. When you left home, things are very positive, good, but on the way around Boralle, there's a severe flood. There's a severe rain in the Boralle area, probably you may under flood. So there are so many things that could happen the way, so you can't come to the class on time. So that is basically risk as an individual. So similarly, as bankers, you are facing so many risks. So in simple words, the possibility that actual outcome deviates from the expected due to several adverse events in the future. Now, when we talk about risk, in broadly theory, we can classify risk into two categories: pure risk and speculative risk. So if we talk about pure risk, a risk for which there is a possibility of loss, but no possibility of a gain. So in a pure risk event, we always talk about adverse event. So we don't see any, because when we talk about risk in real life, risk can end up with a loss or even a gain. Okay, risk can end up with a loss and a gain, because for example, when I say the expected profit for the bank is 10 billion, it may not necessarily you end up with 8 billion, you may end up with 12 billion. Okay, so it is more than what you expected. So you end up with a more gain at the end of the day compared to the expected event. So, but there are certain types of events which will always end up with a loss. Pure risk arises when the actual outcome of a particular event is worse than the expected outcome and result in a loss to the business in person. This is also called the downside risk, as the event only result in loss and there is no possibility of a gain. And if the event does not take place, the business can achieve its expected income. A classic example, you meet with an accident. You can't make a gain out of the accident. Always the risk event is meet an accident, you end up with a loss. Okay. So one good thing in pure risk event, okay, I will come back to it later. Pure risk event, you can cover up with the insurance. Okay. So let's move on to the speculative risk, a risk for which there is a possibility of either a loss or a gain. Okay. So as I mentioned in the profit example, you may end up with a gain also due to the risk event. Okay. Speculative risk arises when the actual outcome of a particular event is either better or worse than the expected outcome. You expect 10 million profit, you end up with a 12 million profit. Okay. So this is called the two-way risk, and the risk event could result in either a gain or a loss to the business. So these are speculative. Now, if you look at the trading business of a trader in a bank, so he trades in government bonds or corporate bonds. So he has downside risk as well as upside risk. So basically, upside risk means you end up with a gain. Downside risk means you end up with a loss. Okay. So let's talk a little bit on risk and uncertainty. Now, sometimes we talk about risk, and sometimes we talk about uncertainty. This uncertainty we used to say there's a greater uncertainty of this particular event happening. Okay. So what is risk? Risk has an unknown outcome. Okay. We never know what would be our profit, unknown outcome, but we know what the underlying outcome or outcome distribution looks like. But one good thing in risk is we know the underlying outcome or outcome distribution looks like. We can forecast a little bit using the probabilities and possibilities. So we can apply mathematics and statistics into a possibility of a particular risk event happening, and we can get ready for that. And we know what is going to happen, what could happen if this is going to take place, at least with some certainty. So when you talk about risk, always there's a certainty attached to it. But what is uncertainty? Now, if you look at uncertainty, it also implies an unknown outcome. So there is no difference between the final result. We are talking about unknown outcome, whether it's a risk event or uncertain event. But in an uncertain event, we don't know the nature of underlying outcome distribution. Can you give a critical example? Anyone? About uncertain event? On any area. I'm not just referring to banking, anything, on anything. Can anyone tell? No? Think about COVID. Can anyone predict where the COVID would end? How many lives would we lose? How many people will be infected? No. Great uncertainty. If you look at a couple of months ago, some predicted using some statistical methodologies in US, Europe, the deaths will be to this level by August, or your cases will be this level. But now we are talking about second wave in many countries, and the numbers have increased. Okay, so what do you have? There's a greater uncertainty because we have not experienced a similar COVID thing before, because we don't know underlying distribution. We are dealing with unknown outcome. So can any of you tell, or maybe the people in US, we end up with 2 million loss of life, 250, we never know. Or COVID will end by this time, we never know. Because we don't know underlying outcome distribution. But we don't have any experience. We have never seen it before. Of course, 5 years later, somebody can tell, okay, if COVID take place, then what could be the outcome like? What would be the result like? Okay. Because we have experience, we have some data, we have some statistical modeling. So the uncertainty can be predicted so that it will no longer be uncertain. So that's why. So which one is more dangerous? A risk event or uncertain event? It's definitely uncertain. We never know uncertainty. Okay. So as I already explained, risk and uncertainty can be explained in more broad terms as follows. Risk is a state of uncertainty where some of the possibilities involve a loss, catastrophe, or other undesirable outcome. This can be measured by considering a set of possibilities, each with quantified probabilities and quantified losses. Okay. So, at least we can think of a set of possibilities, each with quantified probabilities and quantified losses. Okay. Now, can you give example of a risk event? I mean, general example of life. I mean, explain what I said about set of possibilities and quantified probabilities and quantified losses. Now, take example. You toss a coin. Sorry. If you toss the coins, is it as you are associated with a risk or uncertainty? Can anyone join us? When you toss a coin, do you associate with a risk or uncertainty?
It's uncertainty.
Uncertainty. Why do you say uncertainty?
There are two options,
Yes.
either head or tail.
Yeah.
So which side is the uncertainty? There is no risk. Either side will fall.
So when from what you explain, what's your good name?
I'm Tamara.
Okay, Tamara. Now I think what you said itself carries some probabilities, isn't it? Possibilities. What you said when you toss a coin, you know either it should be head or tail, two sides. So that means what? You know possible event that could take place. Okay, isn't it? You know a possible event, two events that could take place. You also know the probability. And you also quantify. So what is it then?
Risk.
What is it? Is it uncertainty or risk?
Risk.
Huh? Please come on. Is it uncertainty or risk? Huh? Isn't it risk? Because there you can measure. Because you exactly said, you know, of course, you may not win. Okay, there is no uncertainty. There's a certainty. There's a risk. Risk is, say two captains go to the middle of the field and toss a coin. But the risk is you may not win the toss. Is it all right? Tamara? You may not win the toss, but you know the possibility of winning or losing. So at least you can predict to certain extent this could happen. So what is the chance of I am winning? What is the chance of I am losing? So then as a risk manager, I can take some measures to manage it. But let's say somebody comes to the top of a hill, okay, and want to jump from the hill, maybe 8,000 from 8,000 feet. So if someone asks, is there a risk or uncertainty associated? What do you say? Anyone? Survival of, is it the uncertainty or risk?
Yes or no?
Huh?
Uncertainty.
Uncertain, definitely uncertainty, because we have not come up with any data, any possibilities of outcomes. So we never know. We have not experienced. But so that is the danger. That is the danger, because as a banker, when you face with an uncertain event, you can't at least predict or with the probabilities, or you can't identify possibilities to take certain precautionary actions. So you have to be very careful. Very careful. So there is always risk is associated with uncertain. Risk can be measured, whereas uncertainty cannot. Now COVID-19 is a classic example. How many of you predicted COVID will take place in 2020 or later part of 2000? Any of your banks have made some provisions to COVID-like thing? Any of your bank? in 2019? Have your banks made some provisions, been ready?
Nothing.
Nothing. I don't think anybody will, unless you are a super god. Okay, nothing would happen. Okay. Even the people like I mean, most of the people believe in these, astrologers guys, don't you? Huh? Sri Lanka is very famous for that. We go behind. Huh? Can anyone of them predict it? COVID? Huh?
No.
So they have been telling, you will die, this, that. I don't believe, but many people used to believe. Huh? Have any one of them come? But recently, I used to listen to them. Then before the 2020 begin, all of these were predicting very good Saubhagyamat. Huh? Prosperity. But now what they can tell? So how can they predict? I mean, even they can't predict. That's the truth. We are going behind unknown stars, which no one can predict. So that is the danger. And if we are talking about superpower US, were they able to predict COVID? No. If they predicted, definitely they would have taken measures. Okay. So that is the danger. So the risk is always associated. Uncertain risk can be measured, whereas uncertainty cannot. So surprises. Any organization that has encountered unwelcome surprises or unexpected losses will realize that most were preventable. Okay. Sometimes there may be surprises. So we must be ready. Okay. So if we are ready, then we can minimize these losses or even preventable. So such events will almost certainly have been caused by risks that were not fully understood or processes to mitigate those events being inadequate. So sometimes surprises also take place, but if you are ready, if you had enough measures in place, you would have avoided such risks. So very simple questions. What are the worst things that could happen to us? Here I am talking from the point of view of a bank manager. So what are the worst things that could happen to your bank? How likely are they to happen? Are we taking sufficient steps to prevent them? Okay. So worst things. We know general things. Okay. General things. The customer may fall. Your system may go bust. But there may be certain other things which we are experiencing right now. Okay. So how likely they are to happen? And the important question is, as a bank risk manager, are we taking sufficient steps to prevent them? Sometimes certain things we can prevent. This event, we can't prevent the risk event taking place, but we can prevent the loss arising from this event taking place if we have deployed appropriate risk management policies. So that's why when we talk about capital adequacy, we always tell you must have sufficient capital above the buffers. When we come to that part, we will look at in detail. So why you need sufficient capital above the regulator set limit is if there is any event, adverse event, severe adverse event take place, you are ready with that. You are ready with that to meet that loss arising from this event. No one can stop the risk event taking place, okay, but you have sufficient buffer to bear that loss so that still you are safe. Okay, so that's why we tell always now, when you are moving on the road, what is let's take example, you are driving on the road. So we know there are so many risk events that could take place. Tell me one of the actions that we could while we are moving also in a, we can't move, we can, what you call drive at 10 kilometers per hour or 20 kilometers per hour also to avoid any accident, but still you can meet in an accident. But few things that you can do to avoid any, even if risk event, we can't stop risk event take place, but to stop loss arising from risk event. Can you think about an example? Always drive with a gap, isn't it? Let's say you never expect in this country, there are two legs bulls also sometimes. Okay, you never expect the crossing is there, but from where the two-leg bull cross, not in the crossing, but some other place. Suddenly, there's a vehicle moving in front of you. Okay, in front of the vehicles, two-leg bull cross. You know what I'm referring to, two-leg bull. Okay, so what happens? The vehicle moving in front of you brake, but because he had to face an unexpected event. Then what happens? You're also driving pretty fast, but not with adequate gap. Then what happens? You go and hit on the vehicle in front. Okay, so you are facing an unexpected event because of certain event faced by the vehicle moving in front of you. So if you had, even though you are driving fast, if you had some space between the vehicles, then you would have braked and the brake would have stopped without knocking the vehicle moving in the front. So you would have avoided the risk. Okay. So what is the important thing? Can we stop risk event take place? No. Okay. We can't stop. But we can minimize, if that risk event take place, the loss which is going to cause us. So we can minimize the loss at the beginning as a banker. Let's say you give a loan, so you can analyze the loan properly and you can ensure your adequate safeguards behind you when you give the loan. You can't stop customer defaulting. You never know. Now, in the COVID, even the good customers can't pay you. Not because they are willing to do it, because they don't have any business. Now take examples of probably your banks would have given significant amounts of loans to the companies in the garment industry, which are facing significant crisis now. But when you give the loan, you never expected them to default. Probably they may default soon, already defaulted. Why? Because they don't have any business. Two, maybe they are major buyers in Europe, US. So if they don't have a business, they don't get cash flows, so they can't repay your loan back. Okay. So, but what is that? It's an uncertain event, which led to problems in your bank, possible losses in your bank. So, when you give the loan, if you had adopted or if you have adequate capital placed to cover up the loss arising from such a risk, then at least you are safe. Otherwise, you will have a problem or risk of surviving in the long run. So what are the pressures we should put in, or what things we should put in place to ensure you are comfortable with any risk? Remember, we can't stop a risk event take place. Okay. Greater transparency. So human processes should be very transparent. Okay. Better governance. The good governance structures. You see, the cases where these failures like Enron, Barings, whatever maybe BCCI, if you look at, one of the key elements of risk has been the poor governance. So we need to have better governance cultures. At ethical standards, you must follow good practices, good ethics in your banks, in your institutions. Especially as banks, you are dealing with public money, depositors' money, not like any other business organization. So ensure you follow good ethical practices, standards. Need for early warning systems. Because when you see certain things, of course, uncertain events you can't predict. But there are certain events. So events you can predict with certainty. This could happen. So at least have an early warning system. So before the event takes place, there are signs of possible risk events could take place. Now, can you think about any risk or early warning system with respect to your day-to-day business, so the working environment, in any way? I mean, it may be particular business decision you have taken, but anything on your banking or financial institutions business where you have some signs of problems, where you can take some actions in advance. So these are called early warnings. Can any one of you give an example you have come across and you have acted upon it before the event take place? Anyone? I would like to hear from any one of you.
Arrears in loan repayments.
Sorry?
Arrears in loan repayments and check in accounts.
Yeah, okay. So how do you, I mean, link it? I mean, you came up with that.
So we give that idea of maybe defaulting the loan.
Yeah.
Likewise.
Okay. Anyone else? That's fine. Yeah, you are Chamat or who was?
Dimutu.
Okay, Dimutu. Then anyone else? Anything else? I want to make this session live because it's rather these online sessions are a little bit boring because I am talking to a laptop. I don't see any of you. So any other thoughts by anybody else? Don't worry about even if you make a mistake, but these are your experiences. Yeah, I didn't. Dimutu came up with a few things, but any other ideas? Anybody?
That warning advances, limiting the advance limit without increasing the amount you pay when the gold prices can go up and come down.
Okay. Oh, that's a measure. Yeah, that's a measure. But what I'm saying is now in your environment, when you deal with people with respect to anything or any businesses, have you come across any signals, early warning signals, where it indicates you will have some problems in future so that you can take appropriate measures? What you said is a mitigation of warning advance, but possible signals. I'm asking possible signals with respect to anything where you see you must take action now. Anyone?
So for example, currently some of the imports were restricted. So when we are going to give any loans to those kind of customers, we can just go to the HS code and see whether these businesses will be impacted in the future. For example, tire imports have been restricted. So if a customer from a tire industry comes approach us to get a loan, then we can consider that as an early warning because we know that there will be an issue in the future.
Okay.
They may not be able to repay us.
Okay. Thank you. Okay. So there are a couple of thoughts. Okay. Now let's say another classic example, because most of your banks are exposed to the credit risk to a great extent compared to other risks. So when you give a loan to a customer, okay, it is usually a covenant in your business that that customers are supposed, let's say I'm talking about from the point of companies, supposed to provide their annual accounts to the bank, okay, before, after, after the financial year, before a particular period. Okay, so you see there are delays in submission of financial accounts or the audited accounts or whatever. Okay, so when you see, so this has not happened before. So you see, even a good customer, even good customer used to delay. So he is coming up with a lot of examples, for the delay. So then it gives some, suspicious about something going wrong with this particular person. Okay, then maybe he wants some time to repay the loan in advance, which has not been happening, but the reasons given are not acceptable. And there are a few things mentioned by our two colleagues about import restriction and the other one. So there are signs which you don't see from a customer or maybe business event where there is a possible, there's a suspicion or doubt of a future risk event. So those are early ones. So you, in a system, in a bank, you will see your NPL is gradually increasing. Okay, customers defaulting in a maybe particular sector, like a sector subject to some import restriction or whatever, or maybe you see the interest rates are increasing in United States, and you hear the news that the US Fed is going to raise the interest rate because economy is under depression. So when you see that, okay, you have a foreign exchange portfolio, and probably the increase in US interest rate may lead to demand for US currency, and what happened? Our currency will depreciate further. So if you have foreign currency exposure, then definitely your foreign currency position will be impacted. So you will see certain things happening in and around the world, not in Sri Lanka alone. Now, if you like foreign exchange, there will be certain things happening with respect to US or Europe. Okay. Then you will see in Europe, they are talking about imposing a tax on Sri Lankan garments. You see, there are discussions going on. So your bank has granted so much loans to the garment sector. So what do you see if they impose a tax? Because now the advantage our garments have is in Europe and US, there's a tax benefit, so that our prices are pretty cheaper. So we can compete in the Europe, and let's say the respective US and Europe governments increase or remove the tax concession, and then what happens? Our prices are expensive, so that they have to compete in the international markets. So probably their markets, they lose the market. So losing the market means they may lose their business. So their profitability go down, then their cash flows will affect it. So when you see certain things happening, okay, which could lead, this doesn't mean they will impose or they will remove tax, but you see, US and Europe are talking about removing taxes, not only to Sri Lanka, the third world countries from which they import. So you see possible early warning. Then what you can do? Okay, you can discuss with your customers, or you can rearrange your facilities. Or you may think twice when you grant further facilities. You keep this in mind to avoid yourself is subject to risk because of business impacts on those customers, your customers. So you can set many limits, okay, to safeguard whatever the risk, credit risk, market risk, operational risk. Okay. And even if within your employees, there are so many early warnings could happen. Okay. About operation, when you talk about operational risk, there are early warnings coming from the employees also. Managers, CEOs. Okay. Then it gives early warning. Okay. So you have to be very careful about those things. So probably, I don't know whether you agree with me. If you look at certain operational risk event. Now, when I talk operational risk event, could you give an example of operational risk event, internal operation risk event of a bank? Just one example. Some of you are in the operational risk area, I think. One small example of operational risk event in your bank. Internal, because operational risk means internal or external. Internal. Classic example.
Disruptions to the systems.
Yeah, okay. Okay.
The systems not available.
Yeah, that's fine. But I mean, which I want, you are right, you are exactly right. But another one like
frauds taking place.
Huh?
Frauds taking place.
Yes.
Or misappropriation of assets.
Employee is robbing some money in the vault, or cashier is playing with the money. A very prominent example in Sri Lanka, in many banks. Okay, but sometimes you will see, if you really analyze the background, you will see the possibility. Okay, so now can you think about early warning systems? A person has played with money. Any early warnings you have seen? This could happen. We never know. But when you analyze the things, we have seen any warnings you have seen by a person played with money. Anything you have seen or you have experienced, maybe your managers have talked of?
Differences in pay and cash balances.
Okay. 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 Right. So you see, you always see some balances problems. Okay. Anything else? I am talking about reality. I mean, real signals you see. That's why certain things, when we see certain things, we don't expect, okay, about even, I mean, people, but these are things which we have experienced, maybe in your banks also. Real things, I'm talking about real things, real signals. I'm not talking about NPL coming down the line, but when you talk about employee being engaged with theft. Anything, any real things? So these are the things, I mean, these are maybe off the textbook. You have to see as a banker.
You're giving passwords to others.
Sorry?
You're giving passwords to others, trusting them, but then the frauds can happen.
Passing the work?
Passwords.
Password.
So you trust a person and then give the password. So
that is something that you should not do, but it's not a risk. But what I'm saying is, in practice, certain things when you see, I am here for particularly taking a theft by a person. Okay, when you see, you can guess there could be a possible future receiver. I mean, you have to be mindful of those things. I just want to bring that example. Likewise, it's very clear. So that anything else?
If that cashier is moving about in a certain time of the day, or certain person coming to office and meeting every day or something like that?
Yeah. So cashier has a practice of going very late despite he has finished his job or whatever. Yes, right. Anything else? You see suddenly, some small fellows coming with big vehicles. Sometimes, when you talk about, certain officers, they are expanding beyond the means, you see. Suddenly, they don't tell you, but somebody tells that Bagge has built a 5-story house, 3-story house. Huh? Bagge has bought a, Mercedes or whatever, beyond his capacity. So likewise, certain triggers, like what you said, okay, going late, he used to work little late, every day. Sometimes you may not agree, but sometimes if you look at certain institutions, who has played the money? The most trusted person. Do you agree with me? Sometimes this is the tactic they use. They've been very trusted. So when you are too much trusted, what happens? The people lose because people place high confidence in them. So people start revealing many more things. So we are the person who wants to do the bad thing, get the benefit. So there are, and these are classic operational risk indicators in advance, you can look into to avoid certain things are happening. So probably, when you see, you must, see why his guy is waiting in the bank long hours after he finish, he goes to, lunch every day in a 5-star, he's been a cashier and he's been, he's standard, he came up from this level, but he's having his lunch, buffet at 5-star every day. Isn't it a warning signal? Okay, so you must be suspicious a little bit. How is this kind? I know there's a case that ultimately, when somebody came up with a, stealing money from vault, then when we asked about the supervisor, he used to say he was the best person among others, because whenever the supervisor assigned him something, he never says no. So, but ultimately, he was the culprit. You see, I just want to bring that classic example. So likewise, many more things relating to your business, you can find out which gives an early warning. Credit risk, market risk, operational risk, even liquidity risk. So many things. So better have early warning system in place based on your experience, which trigger a possible risk event taking place, so that you must be ready in advance. So that's the important thing. Early warning system. The idea is you must ready in advance. You like say NPS going up. Even your good AAA customers start non-paying. Then suddenly your high liquid assets, are liquidated. Things related to operational risk, frauds, system failures. You see your system, somebody said about system failure. Your system is subject to continuous, hacking or maybe problems. If you look at recent past, one of the significant threats was the hacking of systems by, the hackers. So somebody enter into a system, then steal the data. So likewise, if something going wrong, let's say in your house, you used to see, every time, your, lights when you switch on start bubbling, then something wrong, maybe current is not coming. So you must find out. But if you don't look at, suddenly you see house is on fire. So there has been a electrical leakage in between. But there were signs. What were the signs? When you switch on your lights start bubbling. But you just ignore. You may say, the power may not be enough. So this happens couple of months. Suddenly one day you see your house is on fire. Why? Because the signal came earlier with bubbling of, lights when you switch on about this, some electrical leakage, but ended up with a disaster. So it's very important. When you see signs, you must take action. So need for early warning systems and signals, demand for higher quality service, ensure good quality people in place. If you don't have proper legislation, new legislation, systems reforms, project management. If you like today, now we are talking about technology. It's very important. You have adequate safeguards in your bank or financial institutions to ensure you are free from, or you are covered to a significant extent from the technological related risk. Because if you see, I don't know how many of you have heard about 2 weeks ago, you have seen the hackers enter into the accounts of many or their websites of many leading personalities in the world. The big players, big here in the rich people, so and they have still some information. So that is the danger. Even during the COVID period, what happened, most of your banks were engaging in online transactions and internet transactions with your customers. But you have seen some banks were hacked due to the improper system. So have good systems in place, okay, and good project management, especially with respect to project lending. Analyze the risk properly before you start lending to a project or a customer. So when we talk about risk, let's have a brief overview about classification of risk. So general risks are classified according to their so-so characteristics. However, there is no standard or established system. So there is nothing called, this is the exact risk classification. Which I am going to do today is what I see ideal. But let's say tomorrow one of you see a textbook and find out something else. Don't tell that, you taught this way, which is not right, but I saw in this particular book, this is the way. So there is no particular standard saying, okay, this is the exact classification. But this is somewhat, use classification to categorize different risk of a business entity. Okay. So if you look at broad company-wide risk, it's a whether bank or any other institution. I think from your perspective, this is something you have to look into when you take decisions with respect to the credit. Because when a customer comes, what you all do before taking a decision? What you all do? So what you have to do? Okay, let me put this way. What do you have to do before a granting loan, or what you are doing at the moment? I think some of you are in the credit risk area, or maybe you have been in the credit risk. So what things you would look into, and what is the expectation of all those things from a risk manager's perspective? If somebody comes to you, whether an individual or company, to obtain a loan, so what will you do? Any ideas, any thoughts? So what will you all do from bank's perspective? Let's say company A comes to you and asks for a 200 million loan for whatever purpose. So what will you do? And what is the objective of doing all those things? Any bank, or anybody else, our auditor or our lady from Vyamba University or whatever, or audit firm, anybody. It's not just bank, so people in the finance. Anybody can come up with any thoughts.
See the repayment capacity.
Yeah, repayment capacity. Okay. So what will you do?
Security.
Okay, security. But before all that, that's fine. But what do you do? Okay, repayment capacity is a must. But before that, okay, what other things look at? Okay, of course, repayment capacity is a must. to ensure
evaluation the customer.
Sorry?
Establishing the identity.
Huh?
Evaluation of the customer.
I can't hear you. Okay, track record. Yeah. All those past events to ensure the repayment capacity, honesty. But before that, okay, many other things you should look into.
Yeah, we have to. I think we have to look for the roots where the risk have came from, the sources where the risk arised, the situation arised. So we have to collect information regarding the risk or the limitation arose. So we have to find the source at first.
Here we are talking about a new customer comes to obtain a loan from your bank. It's a company A comes to you, you are the banker, to obtain a loan for 200 million for whatever purpose. Okay. So now before giving loan, what things you should look into from your, now some people said, okay, repayment, that's fine. Because anyway, you have to assess repayment. Then his fast record, if you have already been bank with, then past record or from any other bank. Then what else? I mean, importantly, okay, all these are.
Purpose of the loan?
Yes, the purpose, the purpose for requesting the loan.
Yeah, purpose and also the business. I mean, what is the field in his working? What are the risks the business faces? Because ultimately, in the books, he has the capacity to pay, but if the business is going to have some problems in the future, he may not be. He may be a very good, honest person based on past record. But if the business is going to collapse, then he may not be able to pay. So you have to look at the business risk and non-business risk, your perspective. Among the business risks, you can analyze your capacities, past track record, all those aspects. Now, for example, let's say a prominent Sri Lankan garment company asks for a 1 billion to 500 million loan today. Okay, so what do you look at? Tell me, prominent Sri Lankan garment manufacturer, main business in US and Europe. So what are things you would look at? Wow, what risk you will see? Okay, I'll put in that context.
The demand.
Yeah, okay. Now, if you look at past track record, definitely he has been a good customer, but is it sufficient? No, because he has been a good customer, no question with. But now there's a question of there is no demand, orders have been cancelled. Okay, orders have been cancelled, and they have delayed the payment also for the existing orders. So definitely the guy is going to have problems. So I'm not saying that you are not giving the loan, but you have to look the possible risk when you grant the loan, because there are a lot of risks the particular business will undergo. His cash flow will not be sufficient due to these business risks. It's very important. So that's what I said. It's very important to look at the business or non-business risk from a customer perspective when you take your lending decisions. So let's move on to broadly the company-wide risk, business and non-business risk. So if you look at business risk, I have highlighted here product risk, macroeconomic risk, technological risk, and non-business risk. Again, I am referring to a general institution, not just a bank. Remember, if you look at bank, still you have these risks, but in the bank's context, we mostly talk about financial risk, which is highlighted here: market risk, credit risk, liquidity risk, operational risk. But you are subject to the legal risk, reputation risk as well. But when from a banker's perspective, key risks are financial risk. But here I am talking a broad point of a company. So non-financial risk, twofold: event risk and financial risk. The event risk, legal risk, reputation risk, disaster risk, regulatory or political risk. The financial risk, market risk, credit risk, liquidity risk, and operational risk. So this is just a classification, but this may not the only classification. But you will, if you read a textbook or whatever, you may find different. But broadly, the risks are like this. Okay, so business risk. So business risk for an entity are those risks arising from the nature of its business and operations and out of business conditions. So business risks are very speculative risks. They can create both gains and losses. So it's arising from the operations and out of business conditions. Okay. The major categories of business risk are product risk, macroeconomic risk, and technology. So if you look at business risk, the three broad risks: product, macroeconomic, and technology risk. Now, as an example, I mentioned about the garment manufacturer. The product risk arises due to the loss of demand for products and services of a company due to various factors. The demand may drop due to development of better products by competitors, poor quality, inability to cater to latest styles and needs of the customer. Now, today, what happened? The business risk, because the product does not have demand, not just because of poor quality competitors, but the market is not there. Or it's basically the macroeconomic conditions in other countries. But the product risk can come from the poor quality, competitors, new entrants, or maybe not capable of giving the product which is needed by the present customers, because styles will change and so on. Then macroeconomic risk arises due to unexpected changes in macroeconomic conditions. Business of a company can suffer due to recession in the economy with lower demand for goods and services produced by the company. Now, this is a classic example where the garment manufacturers losing their businesses because of macroeconomic conditions in other countries, their markets. So, where you don't have demand. So, that's a business risk element. Technology risk, as you know, arises due to changes in technology affecting the type of products or services offered by a company and failure to adapt new technology. Now, for example, we'll take this class today. I mean, if the IBSL couldn't adopt technology and reach the bankers or the students or people interested in doing these courses, let's say COVID will be there for 1 year or so, where still it's not allowed to do the physical classes. Then what happens? The IBSL also lose business. Okay, so that's a risk to the IBSL. Okay, that's a risk to the IBSL. Okay, so you have to be very careful. So banks which are not, now take example of banks. If you are not capable of adapting new technology, such as internet banking, phone banking, and especially in the context of now today's COVID, you are losing customers. Okay. Very important. Today, people want to minimize cost of traveling, cost of whatever the other things, So you must ensure you have properly addressed technological risk. If you have to move with the technology, okay. But technology risk itself can create certain other risks. Okay. So when you come to a bank physically, the chances of you recognizing the person, a fraud happening is less. But when you do a transaction over the internet or other online mechanism, there's a greater risk with respect to it. But again, you have to ensure you cover those aspects as well. Okay, so we will, so those are the business risks. So we will go to the non-business risks. But before that, I think we will go for a break, about 20 minutes or maybe 25 minutes before we start the again. So we stop here at now 10:30 here on my laptop here. So we'll start at 10:50. Is it all right? Okay. Can you all hear me?
Okay.
Yeah, okay.
So we'll stop here for 20-minute break, and we will come back at 10:50. Okay. Please be on the session at 10:50 again. But in the meantime, once we begin the session after the break, if you have any questions, we will discuss them first before moving to the session. Okay, thank you. Nature. And many of these risks are speculative risks, and event risks are from more adverse events that are either internal or external to the business organization. most of these risks are pure risk or downside risk and might be possible to minimize by obtaining insurance cover. Now, I think if you look at COVID-19, which has impacted some of the businesses, is a clear event risk, which is beyond the control of the entities. If you look at financial risk, which is more commonly to the many of your bankers, financial institutions, we will discuss each of them in detail during the separate modules, but for the benefit of the others, let's briefly touch upon credit risk. As you know, this is an important risk to a banker or person in a financial institution because most of your businesses are loans to the customers. So default risk, the risk that debtors of a business fail to pay their dues to the business in full on time. The market risk is basically broadly defined the changes in market variables such as interest rate, exchange rate, equity prices, and commodity prices, which will have impact on value of assets and income of a business. So as a result of changes in the interest rate, equity prices, foreign exchange rate, that will affect your assets and liabilities based on their positions in your bank. So that is the market, but this is for even for any other entity. So basically, we are talking about 4 components of market risk: the foreign exchange risk, interest rate risk, equity price risk, and commodity price risk. So I think for bankers, it's very important foreign exchange risk due to the changes in value of foreign currency position due to changes in exchange rate. The risk depends on the nature of foreign currency position. For example, if a bank has a long position in US dollars, the appreciation of US dollar against rupee will result in a gain, but depreciation of US dollar against the rupee will result in a loss. So again, now what is important is just because of the exchange rate moves up or down, you may not end up with a loss always. That depends on the position you are having in your bank. I'm talking from the perspective of bank. Okay, so that's why if you have a long position, when the US dollar appreciate, what does it mean? The Sri Lankan rupee depreciate, but you are making a gain because you have a long position. But if, of course, if you have a short position, when the US dollar appreciate, or in other words, Sri Lankan rupee depreciate, you are incurring a loss. So ultimately, the position you hold in your bank is very important when you talk about foreign exchange risk, likewise for any other business entity. So interest rate risk, again, is a key element of risk, especially pertinent to financial institutions like banks, because in other organizations, they don't have very much higher interest rate sensitive assets and liabilities. But to take your bank or financial institution, majority of your assets and liabilities are linked to the interest rate: loans, borrowings, deposits, investments in government securities, and so on. So what happens when the market interest rate changes? It will either increase or decrease the value of the market assets and liabilities. So that creates either gain or loss to the institution. If you take a bank, it will affect the bank's value and also change, because if you talk about interest rate risk, there are 2 elements. One is the value effect, other one is the income effect. So both these could happen, and ultimately it will result in loss to the bank in either form. Or maybe risk is lost, but you may end up with a gain as well. Then equity price risk is if you have investment portfolio in equity market, and if you use it for trading purposes, then market value of those equity portfolio goes up and down, may result in either increase or decrease in value or realizable value if you sell those equities in the market. Then commodity price risk is the risk of change in value of a portfolio of commodities. Now, in the case of banks, I think Sri Lanka, I don't think many banks are exposed to commodity risk. If you think about a commodity, we can only think about if a particular bank is buying and selling gold in the market and they hold gold as a commodity, then of course the price fluctuations can result in either a loss or gain. If we have adverse fluctuation, then definitely you will end up with a loss. So that is very important. So then, but other than that, but we don't have any commodity risk for Sri Lankan banks. But if you take international bank, probably certain banks may be still engaging business in commodities, like where there are international markets for commodities. So they are the increase or decrease in value. That means the prices of commodities can result in a up or downwards, loss or gain. And again, liquidity risk. In general, liquidity risk refers to inability of business to meet its immediate obligations. So it has two aspects: asset side and liability side liquidity risk. But this is a very important now. This is important for any institution. But if you take your bank, it's a very important element, because in the case of bank, majority of liabilities are short-term deposit obligations, where if a bank can't pay the depositors on the demand, then you will subject to significant liquidity risk. So that's called the liability side liquidity risk. But on the other hand, say when the demand comes, and if you want to sell your assets, liquid assets, if you can't sell them at a reasonable price, then again liquidity risk of asset side also comes. So the asset side liquidity risk comes when you hold a portfolio of liquid assets, but you can't dispose it at a reasonable price in the market. So that's called asset side liquidity risk. Okay. But liquid risk is one of the key and very important risks when you talk of a financial institution or bank, even though this is a common risk to any business organization. Now, operational risk, we have discussed a little bit before when we discussed example of operational risk event. Is the risk of loss resulting from inadequate or foiled internal processes, people and systems, or from external events. Operational risk can arise due to failure of internal systems, inadequate internal controls, fraud or theft by an employee, or due to an external catastrophe. So that again, so the operational risk has not been a very prominent risk, especially for financial institutions till recent past 10-15 years. But it has become a very significant risk today. That's why in 2004, when the Basel II code came into effect, they decided to incorporate operational risk also in the Basel framework, so that banks are required to make sufficient capital to cover up operational risk. But if you take before 90s, this risk has not been considered as a significant risk. But today's context is a very significant risk, especially now if you look at from the perspective of developments in the technology, and again related risks like cyber attack, hacking and all. So this has become a very important risk for especially for bankers. Okay. Then let's move on to the event risk. There are 4 key event risks I have highlighted. The legal risk. This is the risk of possible legal action faced by different parties against a business for various reasons, such as environment pollution, poor political violation of consumer rights, etc. Again, the danger is that again there's a greater uncertainty, because when something is challenged, how long will it take to resolve the issue? What would be the end result? So it's very important to ensure the institutions are complying with respect to regulations and the law. So if you are subject to legal risk, the cost would be very high. It may be very remote risk, but very high. Reputation risk of loss of reputation, again due to poor customer service, inferior products, and other weaknesses in the business. That's again important, because the whole business survival depends on the reputation. If you lose the reputation due to whatever reasons, then definitely your business, whole business would be affected. including less demand for business products and services, and ultimately losing from businesses and also sales and affecting the profitability. Disaster risk also part of operational risk, which affects business activities as a result of unexpected catastrophe like floods, fire, earthquakes. We never know. Okay. So there will be significant problems. Disaster risk in turn affect certain other risks or lead to certain other risks in your the bank, because the disaster risk as a result of disaster risk faced by certain other businesses, those businesses may be affected, which in turn may default your loans from your bank. So basically, as a result of disaster risk of a particular entity, you will end up with a credit risk event. So that's very important. Regulatory and political risk again arises as a result of introduction of new laws, regulation by the government and regulatory authorities affecting certain aspects of a business. Changes in laws and regulations are usually high at times of political instability or change in political. I think if you can think of example now, regulatory risks, can you give example which you experienced in the recent past? Anyone? Examples of event? Regulatory risks?
That is moratorium concessions expected from financial institutions.
That's right. You are right. So as a result of COVID impact, the regulators ask banks to and the finance companies to allow a credit moratorium for their customers for 6 months initially, but I don't know whether that would be extended, and also some waivers on interest rate. So that's a regulatory which usually don't happen in a regulator's perspective. So new regulations by the governments and the regulatory authorities affecting your recoveries from your customers. So that's a clear regulatory event risk as a result of COVID. So these are the things you have to face uncertain things, So where if you don't have sufficient buffers to meet now, for example, as a result of majority of your customers, affected customers not paying you for some period, 6 months or whatever period, definitely you have to ensure you are capable of managing liquidity during that time. So there are two things, One is even after the moratorium, what is the assurance that these businesses can be revived and they can repay their loan? So if still they are affected and they can't continue their business again, you end up with a credit risk. On the other hand, due to non-availability of cash inflows from this capital and interest for 6 months, then again your cash inflows will be affected, and which in turn may result in your liquidity freeze. So you see the interrelationship of a particular event. Okay. Now all this because of COVID-19. See, it's an uncertain event which has led a bank to, or which has exposed the bank to a number of other risks. Okay, the regulatory risk, then credit risk, liquidity risk. There are so many risks which has impacted a bank. So basically, that's the broad classification of risk, business and non-business risk. Before we move into the risk management, are there any questions or anything you need to clarify before we move into this one? Anything you clarify? No? Okay.
So there are subcomponents of credit risk. Can you explain that?
Sorry, I can't hear you properly. Can you explain clearly? I can't hear you properly. What did you ask?
Yeah, subcomponents of credit risk. There are some the counterparty risk and settlement risk. There are some subcomponents, no?
Yeah. There are. Here we talked about broad risk categories, but within certain risk categories, there may be certain. Now, for example, credit risk, counterparty credit risk, credit concentration risk. There are so many. So probably when we look at Basel framework, we will look at how those risks are addressed in the Basel framework. But here I mentioned only the broad credit risk. So there are other risk or sub risk within the broad category. Anything else? No? Okay. Please clarify anything if you have, because I can't see you. But anyway, it's open for you to discuss any questions. Okay. So if you don't have anything, let's move on to the risk management. Now, what is risk management? We know now risk, we know uncertainty, we know the broad categories of risk faced by a business. Okay. Not just a bank, any business organization. So let's look at risk management. So what is important for us is we can't stop a risk event taking place. Okay, we can't stop a risk event taking place. Now let's take credit risk, a typical risk faced by a bank. So what is, I mean, if we want to totally eliminate risk, credit risk, I'm referring to credit risk as a bank, what you can do? What is the best thing you can do? So if you don't want any risk in your credit, so what you can do?
Stop lending.
Exactly. You must stop lending. So what is the purpose of existing your bank? Huh? So why do you do banking? Huh? Main purpose of your banking, commercial bank, is lending. Huh? If you stop lending, no banking. So that's the best strategy, stop lending. So 100% you are covered, but you know business. Okay, then bank has to be closed. So definitely, if you want to do business, you are engaged with risk. So, but what is important is the risks are all over. Okay, there are, as I said at the beginning, the risk events and the uncertain event. If we can manage risk event, we can minimize the impact to a certain extent, great extent. Then we are left with the uncertain event. That again, if we have sufficient space in terms of other buffers, capital and other buffers, other practices, governance framework, we can still manage. So what is important is the management of risk. So what is risk management? It's a process for identifying, assessing, and prioritizing risks of different kinds. Once risks are identified, the risk manager will create a plan to minimize or eliminate the impact of negative events. A variety of strategies is available depending on the type of risk and type of business. Now, when we talk about risk, the different institutions face risk differently. A particular risk to one entity may not be the same important risk to another bank. You could take your banks, take commercial bank, HNB, Ceylon Bank, whatever. The most important risk to a commercial bank may not be the exact most important risk to Ceylon Bank. It may be different. Okay. So once you identify the possible risk event, so you have to identify, okay, what are the possible risk events? Okay. Loan being defaulted, market value of asset being coming down when you want to sell, somebody robbing the vault money, a hacker hacking your system, or unforeseen catastrophe take place affecting you business. Okay, then you have to assess. Okay, assess it and prioritize the risk. Because if you look at your bank, I'm talking from a point of bank, there are many more risks you face. You can take 1,000 not risks. I mean, I'm talking micro level. So then what is important is, can you manage all these risks? No, I don't think. To managing means you have to deploy resources to each and every risk, but which is not possible in reality. So what is important is prioritize, and you must have an action plan to minimize, or if possible, to eliminate the impact of negative events. So the process like this: identify, assess and analyze, plan of actions, monitor and implement, measures and control. So it's a circle, it moves in a circle. Okay, identifying, assessing, prioritizing, action plan and managing, and again identify, and so on. But the risk will change over time. A particular risk you identified yesterday or last year, maybe 2 years ago, may not be the same risk which you will face in future. So that is a continuous process. So entity can't just forget, okay, I have identified my risk, I have taken measures, and I am so basically I feel I am safe, and I did not do anything new to manage my risk. So you can't do that. You can't stop from that, because risks are evolving. Risks are evolving. I mean, if the world has known about COVID-19, definitely 2 years ago, they would have come up with a vaccine. They have not identified. Okay, but we don't know the next, pandemic. Okay, so that's the difficulty. Okay, it may be totally different. Okay, so likewise, the risk you face may be totally different to the risk you faced yesterday. Certain risks may continue, certain risks may disappear, certain new risks may arise. So it's a continuous process. So as bankers or as business entities, we can't talk risk management in isolation or micro level or individual unit basis. Okay, so as a bank, you have to talk about bank-wide risk. What do you mean by bank-wide risk? So here we talk about enterprise-wide risk. Okay, it's not just credit risk faced by your bank. It's not just market risk faced by the market risk institute. It's not just operational risk faced by operational risk unit. So it is the entire risk for the whole bank. So as per the COSO definition, it says enterprise risk management is a process effected by an entity's board of directors, management and other personnel, applied in strategy setting and across the enterprise, designed to identify potential events that may affect the entity and manage risk to be within its risk appetite, to provide reasonable assurance regarding the achievement of entity objectives. Okay. So it's the broad, holistic view about the risk of an entity and managing risk at an entity level. So it's starting from top, going down to the bottom. So it's all the people in the process engaged in this whole exercise. Board of directors, management and other person applied in strategy setting across the enterprise, designed to identify potential events that may affect the entity and manage risk to be within its risk appetite. One of the important element is risk appetite. With every entity every bank has its own risk appetite. It is different from one bank to another bank. Okay, so you can't compare two banks' risk appetite. Okay, and give a reasonable assurance and achievement. Because the problem is, if you don't manage your risk properly, it will affect your final objectives, which you want to achieve. So what the risk management tries to do, or what the entity-wide risk management does, is ensure you have proper risk management system in place or process in place to manage all those risks within the appetite of the bank or the entity. In more general terms, enterprise risk management is a process ongoing and flowing through an entity. So it's an ongoing process. It won't stop at one point, so it continues through the entity from covering all aspects affected by people at every level. So important is when all units are engaged in the whole process, so every person in the entity engaging and applied in strategy setting. So once you identify the risk holistically, so you can set the strategy for the entire bank or the entire business organization, applied across the enterprise at every level and unit, and includes taking an entity level, which portfolio view, which I mentioned earlier. So it's a holistic view, enterprise view, not just credit risk manager looking at his part, market risk manager looking at his part, operational risk manager looking at his part, no, whole entity. Designed to identify potential events that, if they occur, will affect the entity and to manage risk within risk appetite. So important, what are the events that could affect the entity? It may come from credit, it may come from market, but ultimately affecting the whole entity. So what are the events? So that if you identify it and if you have procedures for manage it within the risk appetite, you are safe. Able to provide reasonable assurance to an entity's management and board of directors geared to achievement of objectives in one or more separate but developing categories. So basically, once you set the framework, it gives a reasonable assurance to the management and board. Whatever risk event take place, you are safe because you have right management tools. So we can't stop any risk event take place. We identify possible risk event that could affect the business and within your risk appetite. So you have a framework in place to meet them. Okay. So let's move on to the components of enterprise risk management framework. Enterprise risk management consists of 8 interrelated components. These are derived from way management runs an enterprise and are integrated within the management process. These components are, so they are in a broad enterprise risk management framework, there are 8 elements: internal environment, objective setting, event identification, risk assessment, risk response, control activities, information and communication, and the monitoring. So let's look at one by one. Okay, so once you establish the context, so let's look at the broad picture. So you have to establish the context. So once you establish the context, identify the risk, analyze the risk, evaluate the risk, and treat the risk. So there are 2 elements which link all this process: monitor and review, communicate and consult. So in a risk management process, another important element is communication. Because whenever you identify a risk, you have to communicate with the relevant people and take action. Okay. So the risk assessment is linked to communication and consultation and monitor and review. So it's a continuous process, as I mentioned earlier. So let's move on to the 8 components. Now, internal environment. So what is internal environment? Encompasses the tone of an organization and sets the basis for how risk is viewed and addressed by an entity's people, including risk management philosophy and risk appetite, integrity and ethical values, and the environment is which they operate. So before setting a framework, you have to identify your own internal environment in which you operate. It is different from one bank to another bank, one business center to another business entity. So without identifying your environment in which you operate, you can't come up with a proper risk management framework. Okay. Here, important elements are risk management philosophy. The philosophy may not be same for all organizations. Risk appetite, the integrity of the people behind the business, ethical values attached to the different operations, and environment in which you operate. If you take, your own bank, where you have certain limit. Now, for example, I want to bring an example of risk appetite. Okay, what do you mean by risk appetite? Anyone? What do you mean by risk appetite? This is a very important element in risk management. Any thoughts?
An amount of risk organization can accept.
This amount of risk that
the risk appetite is like exactly what you said. How much you are willing to take from risk perspective. So, what is your tolerance limit like? Okay. So, if you look at two banks for the same risk event, their risk appetite level may be different. Okay. Now, if you take from a credit example, now take two banks, Bank A and Bank B. So let's say once let's say a customer comes, one bank reject the loan to him, same loan, but the other bank, say Bank A, say when the customer Mr. ABC goes to ABC company goes to Bank A and asks for a 200 million loan, and Bank A says, "We're sorry, we can't give you a loan." But he goes immediately to Bank B and asks for same loan, provide same information. Then Bank B says, "Okay, no problem, I will give you a loan." So what made the difference? Has the risk changed in the customer when he goes from Bank A to Bank B? Did the risk change? When the customer goes from Bank A to Bank B? Why Bank A refused and why Bank B accepted? The customer, same customer. What is the reason? Any thoughts? Bankers? You have seen this.
Risk appetite is higher than the other bank.
Sorry?
Their risk appetite is higher than the other bank, so that's why they accepted the customer.
Yeah. Okay. So the risk tolerance, because has the risk changed of the customer?
No.
No. When I go to Bank A and ask for 200 million, then immediately when the Bank A refuses, I go to Bank B, my profile has not changed. My risk is same. Okay. I'm the same ABC company. Okay. So what changed or what made the one bank to give me the loan, whereas other bank refused? The way of looking me by the Bank B is different to Bank A. The appetite for taking risk. Probably why Bank A refused me, probably within its risk appetite, bank would have identified me as a higher risk customer. So bank want to take me. But when I went to the Bank B took me is not a very high risk customer within its risk appetite. You see? So that is the difference. So when you set the framework, you have to identify your internal environment. I mean, you can't look at another bank environment and you can install the same risk management procedure for you. Your appetite is different. So your management technique is different. Your approach is different. So all this are very important, your internal environment. So I just brought example of risk appetite, but integrity, ethical values, environment in which you operate. Objective setting. Now, objectives must exist before management can identify potential events affecting their achievement. Enterprise risk management ensures management has in place a process to set objectives and that chosen objectives support and align with the entity's mission and are consistent with its risk appetite. So, before thinking of management, you have to set your objective, final objectives you want to achieve. Okay, so without knowing that, you can't set the relevant risk limit, or you can't develop the risk management process unless you identify your objectives. It depends on your objectives only. Rest of the parameters can be set. So, internal environment, you have to have an assessment on your internal environment, your objective setting, then event identification. Okay, once you done those two, then you have to identify the possible events, both internal and external, affecting achievement of an entity's objectives and distinguishing between risk and opportunities. Opportunities are channeled back to the management strategy or objective setting process. So once you set the objectives, so internal environment you assess, set the objective, now you identify the internal and external events, possible events which could affect the achievement of those set objectives. And certain things good for you, but certain things are bad for you. So the good things, the opportunities, you can channel back to the strategy again. Okay. Then risk assessment. Now you have identified the events. Okay, so you identify 1,000 odd events which could result in not being able to achieve the objectives. Now you have to assess. Okay. What do you mean by assess? Analyze, consider the likelihood and impact as a basis for determining how they should be managed. Risks are assessed on an inherent and a residual basis. Okay. So how do I assess them? Considering likelihood and impact. Because even though you identify the risk event, because anybody can identify a risk event, but how do you know whether this will take place or not? Now let's say you leave home at 8 o'clock in the morning with the objective of coming to class at 8:30. So you are in the risk management process. You have identified the internal environment, everything. You have set the objectives. The objective is that coming for the class on time and be in the classroom. Then you are identifying the events. So what are the events? Can you tell me events? Possible risk events. You leave home and until you be here for the class. Come on. What are the possible events, risk events, which obstruct achieving your objective?
Transportation problems.
Yeah, transportation problem, a little bit elaborate.
So not getting the expected transport at the time
Okay,
that I need.
public transport, there may be a what do you
And
call strike?
and the
Strike by
breakdown,
bus
yeah,
operators.
strike and a breakdown in the
Breakdown.
personal vehicle.
Yeah. Then bad weather.
Yeah, bad weather.
Bad weather.
An accident maybe.
Accident. Accident on the road.
Yeah, on
Or
the road.
maybe you may meet with an accident.
Yeah, probably. Yeah.
Yeah. So what else? Huh? Accident also categories. Somebody would knock your vehicle or two-leg bull cross and you knock the two-leg bull and maybe a tree maybe fell on your vehicle or maybe. So there are so many risk events you can identify. I'm just giving an example.
Yes.
So between you leave the office, home and coming here, there are so many 1,000 odd risk events you can identify. But the problem is, can you manage all those risks? No, it's not easy. So that's why you should analyze the risk to identify likelihood and impact. So based on experience, okay, you can analyze the likelihood and impact. Okay. Now, then you can prioritize. Assess on an inherent and residual basis. So what is the risk of today being rain and flooding? What is the risk of tree falling on my vehicle or on the road? What is the probability of bus strike going on? So likewise, when you analyze, you know exactly the probabilities and the impact if that happens on your business. So what road do I take? Well, where are you going? I don't know. So then it doesn't matter if you don't know where you are going, any road will get you there. So important is you want to identify where you want to go. If you don't know where you want to go, then it doesn't matter which methodology you adopt. Okay, so that's why when you identify all those risk events, you are putting them into a matrix. Now here, the two sides or the two axes of the matrix is one side, you have the likelihood, other side is the impact. So what do you mean by likelihood and impact? Okay, so why we need to have a risk matrix? What is the reason for risk matrix? Now we have identified 1,000 odd risks. Tree falling, bus strike, raining, food crossing, so many things. So what is why we do all those things? They put it into a likelihood and impact framework. What is the reason?
To mitigate the risk.
Huh?
To manage and mitigate the risk.
Sorry?
To manage and mitigate the risk.
Yeah, but why we would, I mean, when you have all these risks identified, we can manage and mitigate, no problem. But why we want to put it into a risk matrix, and what is the important reason?
To prioritize.
Yeah, why prioritize?
Then you can treat them in different ways. Methods.
Yeah, but little bit, I know, different ways, but what is the most important thing? Why we want to prioritize? Any thoughts, anybody?
More attention can be given for high risk, significant areas.
Okay.
The approaches also may be different.
Sorry? Okay. So, because now I just mentioned about this, sorry, you are leaving home and coming here for 30 minutes. So how many risks you can highlight for that? Maybe 15, 20 risk event, isn't it? Okay. But if you take a bank, how many risk events you face on your business? Thousands and thousands. So problem is, if you don't identify them in this manner, in the form of risk matrix, it's very difficult to manage the risk, because the risk management is not free. Is it free? No, it's not free. It's costly, and you may not have that much resources. So that's why we must prioritize to identify someone said, most important risks. The risk which could really dangerous to the entity if those risks even take place, and just leave other risks out. So the technique we really adopt to manage risk is focused on the risks which are very dangerous, very significant, and going to affect the bank if those things happens or takes place. So the objective of risk matrix is risk prioritization and identify the important risks. So if you look at this matrix, you have a low likelihood, medium likelihood, high likelihood. Then impact, a minor impact, moderate impact, significant impact. So if you look at the first grid of the matrix, low likelihood and the minor impact. So what do you mean by low likelihood and minor impact? What do you mean by that? The chance of a particular risk event taking place is very low. Now, if you take a highway, okay. Now, when you go on the highway, a two-leg bull crossing, is it a high probability or low probability? Very low, because people can't cross. Or animal crossing, it's very low. But of course, the impact would be minor moderate, or significant. Okay. So when you say low, minor means the probability of taking that event is very low. Even if it happens, the risk is also very low, minor. So in such a case, the risk manager can take a decision. Okay, when you identify those risks in your bank, simply accept it. Don't try to waste your resources on that, because I mean, the impact on your bank is very low. So why don't waste your time on that? Don't put your resources on that. We'll go to the other end. The probability of a particular event taking place is very high. Very high, but the impact is minor. So there's a greater chance of particular event could happen, like flooding on the highway or whatever. So similarly, bank, whatever event. So, but impact is very low. So there's a greater possibility of that event happen, but if it happens, the impact is very low. Okay. So there you can simply forget completely. You can't accept the risk. So you have to manage and monitor the risk. So you have to put a little effort more than the first one. So likewise, if you look at this grid, where you can, I think, if you look at the pure white grids, basically what does it mean? You don't have to worry too much about those white grids. But then you have light ash color grid. So you have to be a little bit more concerned about those risks. Look at the top one, low and significant. Considerable management is required. So you need management. Then middle one, medium and moderate management effort worthwhile. You have to do some management effort. But if you go to the dark ash grids, like medium and significant, high and moderate, high and significant grids. So those are the critical ones you must make a full effort to manage. So must manage and monitor risk. Extend to management essential. Management effort required. So once you build up the risk matrix, it is very much comfortable for the risk manager to find out what are the most significant risks and how should I treat them. So on what resources, sorry, on what risk I should devote my resources. So that's the importance of prioritize. So this is again, now earlier I just took a 3x3 matrix. So this can be extended to any number of categories. Now this is a 5x5 risk matrix. I mean, it's up to you. You can, further fine tune the risk level. Rare, unlikely, possible, likely, almost certain, insignificant, minor, moderate, major, most severe. I don't know. Your banks, one bank system may not be the other bank. So each bank may be having a different risk matrix. 2x2, 3x3, 5x5, 6x6. That's up to the bank depending on the requirement for fine tuning. This is again, similar matrix. So the lowest risk categories 1, 2, 3, 4, 5, 6, 7, 8, 9. So if particular risk is in the categories like 7, 8, 9, you must ensure those are managed comfortably. Otherwise, the end result will be very significant or very adverse and will end up with significant problems to the bank. Now this is again grammatical representation of a risk event. Now here, if you look at how many risk events bank has identified, about I think 28 risk events. So this particular bank or the entity has identified 28 risk events, and they have identified, if you look at the very high impact and very high likelihood the risk event 1, 2, 3, 4, 5 are most dangerous. Then 6, 7, 8, 9, 10, 11, those are the next level, and 15, 16, 14, 15, 16, 17, and so on. So if you take risk events, they identified like 25, 26, 27, 28 are fairly comfortable, where you don't want to devote too much time and spend too much resources. So that's the beauty of a risk matrix. Again, it's a different way. Probably what you can do is you can have a look at your own risk matrix if your bank has one, how you have identified, how you have categorized. Now here again, from a what do you call entities perspective, here what they say, rare means once in 2 years. Event is once in 2 years. Unlikely means once in 10 to 20 years. Possible is once in 20 years. Likely once in 3 years. Certain is once a year. On the impact side, losses under 100,000 or some complaints from individuals. Then next category is 100,000 to 500,000, no unacceptable level of complaints. Then next category is 500,000 to 2 million or reported in local paper. Then 2 million to 5 million reported in national press, or 5 million questions raised in parliament. Okay. So how this particular entity would look at risk. So go to the most significant risk element, certain in once a year, and also losses more than 5 million. So what is the strategy? Immediate action needed, serious threat to provision and or achievement of key services for the duties. Okay. Then on the other hand, the lowest risk category, rare, that means once in 20 years, and losses less than 100,000, no action necessary because entity field, we do not deploy resources to address those risks identified. So this is again another way of looking at risk events. So let's go to the 8 actions under strategy setting. The risk response. Now, once you identify the most important risk through the risk matrix, management select the risk responses, avoiding, accepting, reducing, or sharing risk. Developing a set of actions to align risk with the entries, risk tolerances, and risk appetite. Okay. So you need actions or you need response, and you must identify what is the right response. So the 4 key responses it has highlighted is avoiding, accepting, reducing, or sharing. So either you can avoid it, accept it if it is negligible, you can reduce it or mitigate it, or share the risk. So if you see a particular risk which is very significant and there's a greater chance of happening, and cost of managing is also very high, you can simply avoid it. You should not engage in that particular event, transaction. So that's one way. Okay. Accepting. So if you feel the very rare of this happening, even if happen, your loss is minimum, please accept it. Don't waste your resources on that. In the next category, where more significant, you need to do business, but again, probability is high. Then ensure you adopt a proper risk management technique so that you can reduce the risk. You can manage the risk. So reducing means mitigating. Final, sharing risk. Can you give example of share? How do you share the risk? With whom you are going to share? Anyone, any examples of a sharing risk? With whom you are going to share?
Insurance company.
Yeah, insurance company.
Insurance.
Yeah. Let's say You have a risk of, fire taking place. You have a risk of currency being stolen on transit. So what do? You can insure. Okay. So basically, there what you do. Your risk management techniques is you pass in the ball to another one. So you don't have any risk. So you share the risk with insurance company. Sometimes insurance company may not give you the full amount, maybe partial, but you share or maybe full amount. So you can do that. So these are the 4 key elements how a business entity, how a bank can look at different risk elements based on the risk matrix. Avoiding, accepting, reducing, or sharing. Then the control activities. So what are the control activities? Now, whenever you identify the risk, again one more thing, like risk mitigating, but you must ensure the controls are in place. Proper policies and procedures are established and implemented to help to ensure the risk responses are effectively carried out. So what are the risk responses? Avoiding, accepting, reducing, or sharing. The control environment is very important. Okay. So let's look at few control elements. Now, typical risk control element. Now, usually you find this in the trading platforms in a bank. What are those? Setting risk limits. The risk limits are a tool for both authorizing and controlling specific forms of risk taking as you. So I think all of you have seen in your respective banks investment limits. So you can only invest in particular type of investments within this limit. Setting minimum credit ratings. So within your bank, you may say, okay, you can't invest or you can't lend to a customer or an entity below this credit rating. So it's a control factor, risk mitigation factor. Geographical location. So probably you may have countrywide limits when you lend or when you invest or within the country. To take an international bank, there may be limits. Okay, Asia, this is our limit. Europe, this is our limit. US, this is our limit. Okay, because depending on the risk nature of the entities or business organizations within those regions. Okay. Then currencies. When you see certain currencies are exposed to significant risk, then probably or highly volatile, can set some limits. Dealing trading limit, especially when it comes to buying and selling of securities. For example, foreign exchange, net open position. So what is the position a dealer can keep open at the end of a day? So why? If you don't have a limit, if you keep unlimited position open overnight, the next day foreign exchange, due to some significant foreign exchange fluctuations, you may end up with a loss. Intraday limits within the day, how much limit you can do overnight limit, dealer limit. For each dealer, you make a limit. Stop loss limit. So when you are starting a lose, to stop the loss, okay, beyond which you must exit the market. Stop the loss. Value at risk limit. So always value at risk, we will learn later. It's very important. Risk due to whatever investment, trading, dealing, of a particular portfolio, how much you are going to lose over a period. And you set a limit. You can't lose beyond that. Then credit limits, approval and disbursement limits. You know, in your bank, there are different authority levels for approving loans. So maybe your middle level manager can approve up to certain limit. Then if the loan is above that, probably it has to go to a higher level, maybe the credit AGM or credit DGM. Then if it exceeds further, then it may have to go to the CEO. Then beyond CEO, there may be credit committee. So likewise, there are different limits to ensure better transparency or avoid risk. Sector-wise, geography-wise, customer-wise limit. Single borrower. Now, the single borrower limit is one coming from the regulator as well. The regulators have also put in place certain limits to manage your risk. Okay, what is single borrower limit? What do you mean by single borrower limit? Anyone, any thoughts? It is something defined by the regulation where a bank can't lend to a particular customer or group of customers. Customer means individual or group of companies beyond certain percentage of capital of your company, bank. So there's a limit. So where again try to reduce concentration risk. Now, if you lend everything to one or two customers, what happens? So what is the risk? If you just lend to few customers, couple of customers, what is the risk? Is it too much risky, or you find two good customers and lend them? So you have 100 billion loan portfolio among two customers, or you would like to see 100 billion loan portfolio among 100 customers. Which one you prefer? 100
billion into 100 customers.
Sorry?
100 million into 100 customers.
Yeah, you prefer. Why is that?
Because that the expanding customers, if one customer get default, others there are various customers, number of customers.
Yeah. So the chance of, everybody, when you disperse among 100, chance of everybody defaulting is very remote.
Yeah.
So your cost is minimum. But let's say you have 100 billion among two customers. So let's say 50 billion each. So if by chance one customer default, you almost lose 50 billion of your portfolio. So yes, this risk is very high. So single borrow limit. So you can diversify your lending portfolio among more customers. So for one person, this is the maximum. So there are regulator limits, but again within your bank there may be limits as per your risk appetite. Now, for example, let's say the regulator define the maximum lending that could be made to one person is, let's say, 50 billion. But within the bank, you may have a limit. Okay, my limit is only 25 billion. So you have a much more prudent policy than the regulator. But regulator has allowed you up to go to 50 billion. But within your bank, you have set your internal limit of 25 billion. Whatever customer, my maximum amount to when the best customer is 25 billion. Because that is within your risk appetite. But another bank, regulator limit is 50 billion. Let's say that bank may allow 50 billion, total 50 billion. So that depends on your risk appetite. But the important point is the risk controls you have in your bank. So let's talk a little bit about inherent and residual risk. So what is inherent risk? Is gross risk before controls mitigation, residual risk remaining after applying control. So there is inherent risk. What is the risk inherent? You foresee before controls. So then we have controls in place, then we come up with the residual risk. Okay, once the controls are set in place, we know the exact risk we will face after applying controls. The controls are very important element. Then we will move to the next element of information and communication. Now, we have assessed the internal environment, we have identified the objectives, we have identified the risk event, we have assessed them, we have prioritized them, okay, and we have treated them, and now we have come to a stage we need communication and information. Relevant information is identified, captured, and communicated in a form and time frame that enable people to carry out their responsibilities. Effective communication also occurs at broader sense, going down across the industry. It's very important the risk managers identify the risk across the bank or the company it is communicated to the relevant parties so that they can carry out their responsibility in an effective manner. So it could go from bottom to up to bottom, across the entity. But people are aware about the risk and people are ready with risk mitigation techniques. Finally, the monitoring. The entirety of enterprise risk management process is monitored and modifications made as necessary. So as you go on, you have to monitor the framework. You can't stop from the first day when you establish the framework. So you have to continuously monitor and see whether you are managing your risk properly. Okay, you can do back testing. So what is back testing? Is you can see the risks you identified 2 years ago and what happened today. Have they materialized? And what was the loss? Whether you have made right or wrong assumption, then you can modify the risk event. So maybe 2 years ago you have identified certain risks as low and impact low, but today you see those risks are not low and low. They may be higher. So then you have to modify the frame. Similarly, 2 years ago when you set up the framework, you identify a particular risk which is significant. You have insured that risk, but today you see that risk is not very significant, so you must reduce resource on that. So you need modification through the monitoring. So monitoring is accomplished through ongoing management activities, separate evaluations. So that's very important. And also you have to identify the new areas of risk based on the present environment and future potential threats. So continuous monitoring plays an important role. Okay, are there any questions before I move on to the next part? Are there any questions? Okay. If you don't have any questions, hopefully I think all of you are online with the session. Corporate attitude towards risk. So earlier we talked about the word appetite, risk appetite. So how much tolerance you would place on a particular risk event. So that is called risk appetite. So what is corporate attitude towards risk? Again, how a corporate look at a risk, consider risk. Again, it's appetite. Now, companies' attitude towards risk determine the extent to which its management will accept the risk in order to achieve its corporate objectives. Now, I'll put rather than a banking example, I'll ask you, I will tell you, okay, you climb up 7,000 feet on this particular hill and you jump from the hill, I will give you 10,000 million US dollars. 10 billion US dollars. Okay, it's a pretty simple example. You go to this hill, top of the hill, 7,000 feet high, and jump. How many would you do that? $10 billion US dollars. It is enough for your entire life. You need not do job in a bank anywhere, simply deposit the money in a bank account and you can earn a pretty good interest. How many of you will do that? No one? Or is there anyone? Okay. So that's how you look at risk event. Now there may be people who are willing to do that. Probably you may not, because your attitude is different. Appetite is different. let's say there's a gentleman with the objective of being a billionaire. So what's his objective? Billionaire. So he may take a chance. I will try. I will try. Okay. So how you look at risk is different. Now take an example. Two companies A and B in the retail industry, each with large chain of stores operating in Sri Lanka over the past 10 years. Even though the two companies are well known in the local market, they do not have business outlets operating in foreign countries. So two companies A and B, both in the retail industry, and each with large chain of stores. So they have retail stores operating in Sri Lanka over the last 10 years. But they are well known in the local market, but do not have business outlets operating in foreign countries. So in order to boost sales in the medium term during next 5 years, each company has set following. Each company has set some strategies. Okay. So the company. So what is the company A's strategy to boost sales in the next 5 years, medium term? So company A targets a sales growth of 20% annually during next 5 years, and expect to adopt a strategy of expanding its local retail outlets with small size and local retail outlets network significantly covering all the regions in the country. Okay. So what is the strategy? The overall objective of the company? Achieving a sales growth of 20% annual 20% over the next 5 years. So that is the objective. So they have set the objective. And how they are going to do that? What is the strategy? Expanding its local retail outlets network, covering all regions in the country. Company B also targets a sales growth of 20% annually during next 5 years and expects to adopt a different strategy of expanding its business to overseas markets by setting up a few large outlets in selected foreign countries. So what is the objective of company B? Target sales growth of 20% annually over the next 5 years. But what is the strategy? Expanding its business to overseas markets by setting up few large outlets in selected foreign countries. So what is the difference between company A and B? What is the similarity? What is the difference? Can someone tell what is the similarity? What is the difference?
Similar objective, but different strategies.
Yeah. So if you look at company A and company B in the same industry, operating last 10 years, but both of them have a similar objective. So objective is very clear, 20% annual growth during next 5 years, pretty clear. But strategy is different. Now, company A adopted a strategy of expanding its business through local retail outlets in the country. Company B, totally different strategy, moving beyond local business to the overseas markets and setting few large outlets in selected foreign countries. How do you perceive these two? Can anyone explain? How do you perceive? Any thoughts? Any views? Okay, so it is obvious that both companies need to accept some risk when expanding the business, whether in local market or foreign markets. Okay, so whether in local market or foreign market, when they expand, obviously there may be risk. Okay, there is no assurance whether you do business in local market or foreign market, you are not subject to risk. So definitely there could be risk element. But the strategy adopted by company B appears to be more risky than the company A, since the ability to survive in the overseas market depends on several market, economic, or other specific factors relevant to each country. So this does not mean that the company may not be successful in implementing its strategy compared to company A. However, there is a greater uncertainty associated with the strategy of company B. Okay, so the company B is adopting a more risky strategy because he is not known in the foreign market and he's moving to foreign market to foreign different customer base, and their preferences and other things may be different. Okay, so the survival of the company depends on a lot of unknown factors. Okay, so they are definitely taking a greater risk, but it doesn't mean they are not successful. Sometimes the company B may be very much successful than company A. Because they may find a good business if they rightly identify the needs of the customers in those countries, and if they come up with the right price, the right quality. But there's a greater uncertainty. Why? Because the company B's risk attitude is different to company A. So that's why even among two banks, the example I mentioned earlier, the risk attitude, risk appetite. I go to bank A for a 100 million loan, bank A say no, but I go to bank B and bank B say yes. So how they look at, perceive the risk. Okay, so that's very important when it comes to risk management. Again, before we wind up, let's discuss about what is risk averse attitude. An attitude is said to be risk averse when the decision maker will prefer an option offering the same return for a lower risk or an higher return to the same risk or the lower risk. Okay, so that's called the risk averse attitude. So we'll look at an example. Suppose that a company wants to undertake a project which gives the best possible return with minimum risk. Company knows that there are 4 projects available in the market: project A, project B, project C, or project D, with different risk return combinations. However, the company can undertake only one project due to its limited resources at present. Expected return and risk of each project is given below. Company A, expected return 9%, risk 6%. Company B, expected return 10, risk 11. Company C, expected return 10, risk 6%. Company D, expected return 11, risk 8%. So if you are a risk averse investor, which project you select? If you are risk averse, which one you select?
Project A.
Huh? A? A, B, C, or D? A. Anyone else?
C.
Anyone else? Risk averse.
Project C.
You select C. Anyone else?
Yeah.
C also can be risk is 6 and expected return. Risk averse means low with highest return.
Okay, what did you say? D or B?
C, no?
C, okay. So someone said A, someone said C. Anyone else? Anything else?
It's C, sir, I think.
C? Everybody C, or anybody for A, anybody for B, anybody for D? Okay. So what do you mean by risk averse? Now take A and C. If you take A and C, what is the common thing? The risk is same for A and C. Okay? But return is different. So if you take A and C, which one you select? If you take A and C, which one you select?
C.
C, because same risk, you get a higher return. So if you get a higher return for the same risk, you will select that. But again, then from return perspective, B and C also same. But for B, risk is high. So why do you take a higher risk project for a similar return? So definitely as a risk-averse investor, you will select C because your risk is low, your return is high. Okay. Then if you are risk neutral, what do? The risk neutral decision maker would select the project with highest expected return regardless of the risk, because he is neutral to the risk. So, and which is the highest project gives the project gives the highest return.
Clear.
So definitely, if you are risk neutral, you are neutral to risk. You are not worried about risk, so you only look at the return. So definitely, you will go for D. Now come to the third category, risk seeker. What do you mean by risk seeker? Would be willing to gamble even further and select the project offering the potential for the highest return if the risk is higher. So, which project risk seeker would select? Because he's a gambler, like seeker. He's looking both risk and return into account and bet on it. The risk neutral guy, he is not worried about risk factor. He purely look at the expected return. So wherever project give a higher expected return, he moves for that. Which one risk taker would select?
Project
Any
D.
answers? Any thoughts before we wind up for the day?
Project D.
Project
D.
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 D for donkey.
Yeah.
Okay.
Yes.
Anyone else?
Project B.
Huh?
Project B.
Project what? Which one?
Risk seeker. Project B.
B. Why is B? Okay, but someone said
High risk, high return.
Hmm?
High risk, high return.
High return. So what do you mean by high return? D gives a higher return, no? D gives you 11 compared to B. What do you mean by high return? Can you elaborate it a little bit? Huh? Okay, I don't know whether you can see. Now, if you take project D, so what do you mean by expected return? And risk. Risk is denoted by sigma standard deviation in mathematical form. So project D gives an expected return of 11%. Risk is it could go up by 11 or it could end up with less 8. So the maximum return vary in project D between 19, and 3. Got it? You take project B. This is D. B. Now B, what is the expected return? Average return is 10. So what do you mean by that? You may end up with 10 plus, the risk is 11 and minus 11. So in project B, you may end up with a negative return of 11 minus 1 or 21. Can you all see? Can you see? Did you see what I put in?
It's not visible. Letters are too small.
Okay, so project A, project D, the maximum return, how much the maximum return you can expect? Project D, the expected return plus positive variation, sigma, 19. Can you see 19?
Yes.
Okay. Then the lowest return you can expect is 11 minus 8, 3. So the return from project B varies between 3 and 19. Okay. But for project B, the maximum return you can expect is 21. And the lowest is -1. So if you look at project D, there's a greater risk in it, definitely. But who are we talking about? What is the attitude of the person?
Risk seeker.
Risk seeker. So risk seeker love for risk. So it doesn't matter. He may end up with a disaster of -1. But if everything goes fine, he will make the highest return. How you understand how the different risk the people with different risk attitude end up with the return. Okay, so everything depends on how do you perceive the risk. Generally, in your bank, you are risk averse person. The banks, sometimes some banks are taking risk seekers, but generally bankers, because you are playing with depositors' money, the bankers are generally risk averse. So that's what do you mean by the risk attitude? Okay. So I think we'll stop for the day at that point, and next week we will look at the rest of the part, corporate governance and risk management, and move on. Are there any questions before we wind up? Any clarification? Anything you want to ask? Anything? So this is just a brief introduction, and probably we'll continue for the next week. And thereafter, I think Mr. Lalit Fernand will take you through the credit risk module for a few weeks, and even operational risk part. So I will join you thereafter. So next week I will be taking to cover up the balance part of this. Any questions? No? No more questions? You're hungry? Okay. So if you don't have any questions, we'll stop here. So we will see you next week, next Sunday at 8:30. Okay, thank you.